Welcome back, everyone. It's Michael Rosmer with Richucation. I'm here to talk to you today about what does it mean for an investment to be risk-weighted. Okay, this is the most important number. When you are looking at your rate of return, you must. If you are not looking at a risk-weighted number, then you are lying to yourself. It's hallucination. It's fantasy. It means nothing. All right. I'll give you an example. Unfortunately, some of the early experiences I had dealing with people in the world of investments were advertising extraordinary rates of return. I bought into this story. I've been told, millionaires invest differently than normal people, and therefore you just have to know how to invest like them, and there's these opportunities out there. And that's how come they do so much better than normal people. I went and I found some of these supposed investments. They were promising like 100% rate of return in a year on one of them. Another one was, 50%. Another one was 25%. All good returns. The problem is every single one of those resulted in 100% loss for investors. Everybody involved lost all of their money. Okay? It is irrelevant what the sticker advertised rate is. It means nothing. Okay? What you need to do is you need to figure out what is the risk-weighted rate of return. In the previous video we talked about what is risk. It's the probability and severity of loss. Now, can you know with certainty what the risk-weighted rate of return is? No, of course not. You can't. But the concept, once you understand the concept, you can start to build risk into your calculations and figure out a much more accurate view of what it is that's going on. Okay? So I'll give you a few different examples here. First, we'll just talk conceptually about how we do these calculations. And then I'm going to give you a few specific examples that have come up recently where people have come to me. And then if you have specific questions and you want to look at individual investments, I recommend you bring them to the action classes and we'll deal with them there and help you look at how this concept of risk-weighted plays out. All right, so let's say that you're doing an investment. Let's say it's a mortgage investment corporation, which means that basically you own shares in a company that lends money on mortgages, and let's say it pays out 10% a year. Okay, that's the coupon or the advertised sticker rate. Okay, so every year, say you invest $100,000, you should get $10,000. Okay, seems good. $10,000 better than the stock market typically does. You're getting it as cash flow. That's going to be less favorable from a tax standpoint, but still is not bad. Okay, wonderful. But what is your chance of losing money? Okay, now I'm going to use some simple numbers here just to make it really easy. These are probably not at all realistic numbers, but it'll give you the concept so you can figure out how calculations work. And yeah, it's a little bit of math. It's not complicated math, but it's definitely math that you need to learn to do if you're going to do these investments. Okay, let's say that I have a chance of losing 100% of my money, which on a mortgage investment corporation is fairly low, but possible. And let's say there's a 10% chance of losing all my money. Okay, if there's a 10% chance of losing all my money, then what I would do is I would say, okay, my full amount of money is $100,000 multiplied by 10% is $10,000. Okay, and I'm going to go and I'm going to calculate that against the amount of money that I have, which is $100,000 invested. I'm going to decrease by $10,000 on my rate of return. And look, lo and behold, that cancels out my $10,000 rate of return. The risk-weighted, assuming those numbers were real, rate of return on that investment is 0%. You have no rate of return. You're better off to buy gold or to put your money into a bond or a GIC or something like that pays 2%. So even though that 10% looked really good, on the surface, that was the advertised amount, the risk-weighted amount was 0. All right? What does that mean? Will you necessarily end up with 0% rate of return? No, it does not. It means that, in theory, if you bought 10 of those, one of them would lose all of its money, the other ones would make 10%. And so, I guess actually in that particular case, you actually lose out because you'd have 10, 9 times, it's going to be $90,000, less $100,000, so you're actually down $10,000, which really is not so great. that was assuming 10,000 or 100,000 in each of them. So you're basically not on $1 million invested amount. So that's one thing. So you look at, okay, what is the amount? Well, I'll draw this out for you here so you can take a look. Okay, so risk weighted. My markers are dying on me here. Risk weighted. So we're going to go probability, which is a percentage, and we're going to multiply that by severity. Okay? So if this was 100% multiplied by 10%, it's 10%. That wipes out your rate of return. Let's say that we did, this is more realistic, let's say I lent money on a first mortgage on a property, okay? But say it was really high loan to value, all right? So I lent it to the full loan to value. So it's a $100,000 property, I lent out money based on $100,000, all right. Your probability of default is going to be based on the person's credit rating, typically. That's the theory. In practice, it's based on, how much income they have, and what the circumstances of their life are, and their integrity, and all these other sorts of things. But it's supposed to be represented by credit rating. So let's say that the chances that they'll default are 5%, okay? And let's say that the amount of money that you would lose in the event that something goes wrong, so basically as the mortgage holder, you're going to be able to take back the property, right? But maybe the property has gone down in value, or maybe there's going to be litigation costs, you have to go to a lawyer and things like this to try and get the property back, and there's a fight, and you're missing out on payments in the meantime. So let's say that the severity of loss is 10%, okay? So how would we calculate this? 5% times 10% is going to be 0.5%, right? So let's say that, the mortgage was for $100,000, 0.5%, it's $500 down, and let's say you were making 3% a year, or let's say it was 5% a year, okay? So really what's your risk-weighted rate of return? It's 4.5% as opposed to 5%, okay? So that's how we calculate those types of numbers. Now, I'm going to use some real examples, because those are all theoretical, hypothetical, whatever. Somebody approached me about a real estate investment recently. It was a multifamily residential. Could be a great investment. And we got chatting about what were the criteria that we were looking for, how did they go about buying, and what was the rate of return. And they had these obscenely high projected numbers. So I dug into their numbers, said, well, you haven't accounted for all these costs. And so by my numbers, the 40% rate of return that you're projecting is actually an 18% rate of return you're projecting. Like, okay. However, that's based on accounting for your expenses, but not risk. Risk is all the stuff that can go wrong. And I went through a list of 7 or 8 different things that I throw out as examples of things that could go wrong. So for example, your property burns down. Okay? You're probably not going to lose all your money off it, right? Because you're going to have insurance. But now you're going to have a property that's not doing anything. You're going to have to go through all the effort of rebuilding. There's going to be a cost to that. So let's say it's, $20,000, whatever the number happens to be. You could have a situation where you have a dispute with a partner and you have to go through a bunch of hassle there. And I just went through all these examples of all these things that could go wrong, okay? And I think there were 7 or 8 of them. And you could definitely come up with a more comprehensive list, but in this particular case, I came up with 7 or 8 to show the point. And I said, what's the probability of these things happening? And the probability worked out to being, I think I gave it that in 20 years, on average, one of those things would happen every 20 years. So it was a 5% probability. Again, is it accurate? I mean, you're guessing. Better management's going to decrease that risk. Worse management is going to hurt it. Environment could change. Lots of different things could happen. But it was approximately, I would say, accurate. And so what it worked out to being was the risk weighting decreased their projected rate of return by 2% a year. It's pretty substantial. I mean, 2% a year, I think we were looking at like a $500,000 investment. So, that's $10,000 a year in the difference over time. Here's another example. I was having dinner with somebody, and she was asking me about a software startup. It was some sort of mobile app, and was asking about investing in it. And so basically what I told her was there's probably about a 90 to 95% chance that investors would lose all of their money. Now, of course, the person pitching it is pitching that it's going to go obscenely high, and it might. Okay, it might. But you've got to know that for every Instagram and Facebook, there's a lot that burn out. A lot. And the way that a lot of these guys make money, say the big funds, is they invest in a bunch knowing that, say, 1 in 14 of them is going to be a hit. Maybe 2 of them are going to do okay, and the rest are going to be complete failures. Depending on the type of business you're in, the chances of that are higher or lower. I mean, certain types of businesses are pretty established. Maybe you have a proven track record, a team, the consumer demand is there. As an example, if you're starting a restaurant, something like that, it's pretty dependable, right? Versus if you're doing, the next crazy software startup that goes somewhere big or it doesn't go at all, right? So in that case, if we just say, okay, in this case, I said a 1 in 20 chance that it's a hit, okay? So let's work out how much that would have to be. Let's say, so it's a 1 in 20, that means that there's a 19 out of 20 chance, a 95% chance. Let's use 90 just for an easier number, but a 90% chance of losing all your money, okay? So say you invested $100,000, you have $90,000 lost due to risk, okay? How much rate of return do you need to make up for that loss? 100%? No. 1,000%. That has to, in order to, on a risk-weighted basis, break even, you need 1,000% return. So that $100,000 you're investing has to go 10 times the money. It has to go to $10 million. That might not sound like a lot, or maybe it sounds like a ton. It should sound like a ton. That's a big jump. Huge, huge jump. Let's say that it was worse than that, though. Let's say that it was a 1 in 20 chance that it would be a hit. Just to break even, what do you need now? You need a 2,000% return. 2,000%. That's a big number. Well, are you likely to get that? So that's where you can plan, and there's a great book called 0 to 1, where Peter Thiel, I don't know how you pronounce it, one of the founders of PayPal, talks about this importance of if each one of those things you're investing in doesn't have the possibility of being worth more than the entire fund combined, all of yours, then it's a bad investment. So unless the upside is at least 20 times, it would have to be more than 20 times. It'd have to be 25 or 30 or 50 or something times your money. Unless it was that, then you're better off not investing. If you are, I still would argue that it's not necessarily great, because on a risk-weighted basis, it's just so hard. So unlikely to get a really good rate of return in a situation like that. Warren Buffett's done better than all those other guys, and it's not because of the fact that he's pursued these moonshots. It's because he's done consistent great numbers. So 25, 27, 30% a year, but doing it consistently. It's that risk-weighted rate of return. And this is the last thing I'm going to leave you with, is you'll hear people compare private placement, exempt market type securities, so they're private investments, with something like the public stock market. And they'll say, the stock market only returns 8% a year. That's true. I mean, depending on when it is, and do you factor in dividends or not, all this kind of stuff. But the market on average, let's call it 8% a year. But, this is a very important but, very, very important. That 8% is already risk-weighted. So when I look back 100 years, and I see that it's averaged 8% a year, geometric return, that's a real rate of return. After you've factored in all the ups and downs, the failures, all this risk. Whereas you show up and you say, I'm offering 10, that 10 is not risk-weighted. So in order to have it risk-weighted, you're probably talking about you need to hit 20. And you need to have a really solid chance. And even probably then, it's probably not going to beat the general market, unfortunately. So that's going to give you some context going into our 5 rules for investment, which are designed to maximize your risk-weighted rate of return. And that's coming up in the future videos. If you would like some assistance with risk weighting, and you should definitely evaluate it any time you're investing, take a look at the risk weighting. See whether it's a competitive return on a risk-weighted basis. If you'd like some assistance with that, go join the Richucation action classes, participate with the community. If you have questions, ask us. The team will help you. Take advantage of some of our resources and training, and we'll see you on the next video.